Thank you so much for tuning into the Journey with Christian Devin's podcast, where we talk to amazing people doing amazing shit, and that's the reason why we have this next guy on. One of the things we're always talking about here on our podcast is how we are navigating the international markets, whether they're Asia, whether they're Latin America, whether they're India or South Africa or Africa, and that's why we have this next guest on. He is an expert at really navigating in these asset classes, whether they're public or the private markets in these specific areas. And also, we're going to dive into some geopolitical things, how the new administration, how that's going to impact the financial and the private markets, and talking about the Asia and U.S. relationship specifically. So I'm very excited to have this man on. He is the CIO, Chief Investment Officer at Skybound Capital, the one and only Theodore Shou. Theodore, how you doing, my man?
Very good. Thank you, Christian, for the intro. And we have a show on the show.
I love that. I love that. Well, hey, man, I look forward to this conversation. One of the things I want to dive into specifically is, one, your guys' background. I want to build a reputation, build obviously, what you guys have been able to do thus far in these international markets. And then, of course, we'll dive into a little bit more how you guys are navigating. So give us a little bit of background on obviously the credibility that you guys bring to these navigating these international.
Absolutely. So Skybound Capital was founded by a group of financial professionals who've decades of experience with them about 20 years ago. It was originally set up as a fund of hedge fund house, primarily allocating to global managers. It was rooted in Cape Town, South Africa. But over the past 20 years, the business has evolved significantly with a big shift into private markets. So as of today, the majority of our business are actually in private credit, private equity, and real estate across different continents. The group moved its headquarters to London a few years ago, but at the same time, we do operate across many other different countries as well. So the group has licensed and regulated entities in Africa, in Europe, in Australia, in Asia. We have offices around the world. Many of our portfolios are also global mandates. So I mentioned the private markets that we operate in. We do launch domestic products in most of the jurisdictions where we have operation. But more importantly, all of our teams are contributing ideas collectively into our global mandates and portfolios.
That's awesome. And I want to ask you this because I think one of the misconceptions for US investors specifically, and most of our audience are US investors, there's this misconception of there's this currency exchange risk. And then
Mm.
also there are certain industries or certain geographies, I should say, that have really low to minimal returns. And what I found interesting is you and I, we were talking before this podcast offline of how if you navigate it correctly and find the right assets and negotiate the right thing, you can actually get some really outsized returns. And so I wanted to at first just talk on like the misconception of like, like for example, South Africa or Africa or Asia and how you guys are navigating that to find whether it might be a real estate play, whether it might be a private credit play, whatever it might be, to really get some good outsized returns.
I think let me start with the simplest. I'm biased. I'm biased because most of the time I'm based in Hong Kong. Hong Kong use the currency Hong Kong dollar, which is pegged to US dollar. So to me, there's actually no difference. Hong Kong dollar, US dollar. And therefore, in a way, I'm also a dollar-based investor. So that's the simplest. But that's not just for Hong Kong. What's interesting is some of the markets they mentioned, particularly Africa. Let's take a look at Africa. Many of the African markets and countries, of course, have their own legal tenders. But at the same time, many of these countries are dollarized, meaning they actually run a parallel system. So on one hand, they have their local currencies, but on the other hand, many of the business activities or economic activities are also taking place using US dollar. So again, for those countries and markets, US dollar is not something exotic that they don't get used to. As I said, they do business in dollar anyway. And this is also how we invest. So when we put money to work in those markets, we would prefer to invest in the form of US dollar. With that said, that doesn't mean there's no currency risk. I'll get back onto this very soon. So that is another case of dollar being dominant. Now, there are, of course, other markets where you have a much stronger local currency. For example, Europe, for example, Australia. Their currencies are what we call G7 or G10 currencies as well, hard currency. And yes, you do bear the currency risk, but let me get back to the point that I made earlier. I'm a dollar-based investor. So I might be investing in euro. I might be investing in AUD, but I always hedge them back to US dollar. And when you're dealing in those hard currencies, it's so easy to hedge it. You can go to any broker, you can go to any bank to enter into a forward transaction on those currencies. Now, there are some other exotic currencies that you cannot easily hedge out the risk, or you always will be subject to the volatility of currencies. And I guess I'll split that into two scenarios. One is there will always be markets that you never want to invest anyway. So let's forget about those currencies. We are not going to North Korea. But there are also other markets. Again, let's go back to the example of some of the African economies where you might have to go with a proxy to US dollar. When I say a proxy, meaning US dollar, it might not be a dollarized economy, but they will be more receptive of a foreign currency. The foreign currency could be euro, could be even Japanese yen. I know it sounds weird, right? So you can use that proxy currency to invest, and that proxy is something that you can easily hedge. In those dollarized markets, I'll circle back to my point that you are still subject to currency risk because, okay, I want to lend to a borrower in US dollar, but I know as for a fact that he or she will be using the capital in local economic activity, which are taking place in local currency. So even if as a lender, I'm not directly exposed to that currency risk, my underlying investment is still exposed to that risk. So on those occasions, what happens is, I guess you can try to minimize that currency risk from two aspects. One is to make sure that your borrower has a fat enough margin, right? Meaning, yes, there's volatility in the currency market, but the margin they are making in their local currency is so generous to the extent that they can easily stomach any volatile moves in their local currency rates. So that's one way of minimizing the risk. The other way is even though I mentioned the hard currencies are easy to hedge, the exotic currencies are not so easy to hedge, but they can be hedged. And this is where our knowledge and expertise come into play. We have been operating in many of these markets long enough, and we know the counterparties on the ground who are happy to take on these FX risks to perform as the counterparty of a hedge. And those counterparties are not necessarily the usual suspects like a commercial bank, an FX broker dealer. They could be even a business like an exporter importer who needs to trade these currencies on a regular intervals, and they are the people who might happen to be on the opposite direction of our currency exposure. So the network that we have built with all these counterparties help us to find alternative ways to hedge the currency risk.
Interesting. So you have different ways to not only hedge it, but also mitigate it. And I'm curious because have you guys, so there's a few conversations I've had in regards to deploying capital outside of the US to also mitigate that risk on the currency exchange side of things. And they're using crypto to some extent as the baseline in USDC. I'm curious, you shook your head there. I'm curious, what's your thoughts on that, or have you guys entertained that, or what do you guys think of leveraging USDC crypto per se as a currency to deploy capital?
Quick answer, we have not utilized that. But the second part of that answer is I'm very pleased to see, and I can easily understand why people are extensively using that. So we are not new to crypto. Actually, as a group, we started our own mining activities from more than 10 years ago. That's not our bread and butter. It's more a sideline business, but we always liked it. But back to your point on the use of potentially coins or USDC, I think in our case, it's more about the lack of need so far. I'm not saying we will never be using that. As I mentioned, many of the markets that we entered into are dollarized markets anyway. And very often there's no capital control. That has become more or less a premise for our investment. We don't want to go into a market where you potentially cannot get your money out. And this is particularly important for private market investment because very often you are not only dealing with the currency risk as we just discussed, you're also potentially dealing with a different legal system, a different political system, and there are so many different risks that you're exposed to. Therefore, for us, it's not just about mitigating the currency risk. We want to make sure that we don't work too hard for it. And we want to make sure that we try to minimize the number of risk factors that we're exposed to. So back to your question, the reason why I'm saying we haven't so far used it is more because we are purposefully avoiding it. We try not to get ourselves into a situation where you have to resort to crypto. So that's the starting point. But as I mentioned, I can totally understand why people find the need or the ease of using crypto on certain occasions. Particularly, again, let's use Africa as an example. I don't want to point fingers. There are quite a few countries where either you have the explicit capital controls or it's easy to get money in, but it's sometimes challenging to get money out. And for those markets, if you are not using the physical money or bank transfer, things will be a lot easier. And that's why I think I can comprehend why people find it useful. And the other thing that I want to add is so far crypto has already grown into this very large universe and very large asset class in itself. But in our world, I think it is still not large enough. So if you look at private credit alone, today the global private credit AUM among managers, we are not even taking into account individual lenders, etc. Just managers, right? Fund managers. The total AUM is about 1.6 to 1.7 trillion US dollar. And as large as the market cap of crypto or Bitcoin, for example, or USDC, USDT, they are just too small for the entire market. And therefore, I'm not dismissing it, but I can't be taking it too seriously.
Yeah, and I understand where you're coming from holistically, where you're looking at this. You're entertaining it. You do have obviously some exposure to it, but it's not like your bread and butter, and it's not the way you holistically deploy capital. I'm curious because one of the things so we're underwriting a company. I'm not going to mention the name, but we're underwriting a company in India because we want to have some exposure to India. It's later stage, growth stage company. They got some revenue, they got some traction, and they're doing pretty good. The thing is as I'm talking, having these conversations with other investors, is how do we? Because in the U.S. we can extrapolate that potential valuation and projections in the future because you have some sort of sustainable like financials and some sustainable like currency, right? Here in the U.S. With these other currencies, it's like a variable you can't control, and so it's like a variable though you have to like anticipate or expect and say, okay, when XYZ happens, what's the potential valuation projections? Because then that really determines what's our entry, right? Because, well, I don't want to be sitting there and spending, be illiquid, like you said, for many years and making only $1, right? And so that's the way I think about this stuff. And so I'm curious, what are you guys doing maybe as a team, or maybe what are you guys doing to be able to, I expect that, like you said, there's always that currency exchange risk, but also there are certain formulas or projections or models that you can develop to make sure, okay, hey, if X happens, then Y will this the result, et cetera. So I'm curious, what are you guys doing to extrapolate that out and develop those models properly?
So simply put, I think you're right. We definitely do our own research too. And we incorporate that forecast into our own valuation model, be it a cash flow discount or whatever. But ultimately, it is an intentional exercise in the sense that whether you want to take the active risk of that currency is already baked in your valuation model. And you cannot, so let me give you two extremes. One is that if we fully hedge that out, so ultimately, I'm only exposed to US dollar. And therefore, my usual modeling will not be different from how you do it on a US company, how you do it from a pure US centric perspective, right? So that's one extreme. That's a simplified case. And the other extreme is assuming that I actually want to have 100% of a specific foreign currency exposure. And that goes back to my point on that we actually bake that in our overall model. But every step of the way, let's say every single calendar year, what we do is we have our own forecast on those calendar years as well. We basically will have a forecast for every single, not just year end, but even quarter end, month end. So that when we project all the future cash flow, we have a specific number in mind, and that number can be translated into US dollar. So again, the whole model could still be a dollar-based model, but that doesn't mean we are not exposed to that currency. We are. It's just that we make so many forecasts down the way. And those forecasts are based on the historic work that we've done of those economies, of those markets. And I guess this is the benefit of a relatively large manager. So we have a large enough team. We have many analysts who do not do anything else, who actually only work on FX. And the FX research work they do is doing exactly what we said, extrapolate their research results of the historic pattern and also the fundamentals of all these economies and make forecasts accordingly.
Yeah, and there's a lot that goes into it. That's good insight in regards to the way you guys approach that. But there's so many variables, and so I'm just always intrigued to see how you guys mitigate that. I want to talk a little bit about South Africa as well. I want to pivot our conversation, South Africa and Africa itself as a country. We've had some conversations with some fund managers over there in the private equity world. One of the reasons why is we don't have any boots on the ground, so obviously we want to partner with someone that's boots on the ground. In the conversations we've had, we've probably had maybe 10 to 12 conversations with some different fund managers, and all of them, I'm never really quite impressed with the returns. They're subpar for the risk. And I'd love for you to maybe give my audience and myself an example of an asset. And you don't have to mention the name or whatever, whether it's real estate, private credit, whether it's private equity, whatever you can, whatever you guys have. But give me an example of maybe you guys underwriting an asset in that Africa nation, and then say, okay, the reason why is because of X, Y, Z, and now this is the result of it. So I'd love for you to just kind of share us maybe a case study or an actual
Sure.
asset that you guys have deployed.
Absolutely. That would be a good entry point. The entry point being upon multiple fronts. So first of all, you mentioned, let's just use South Africa, the country, as an example. I circle back to our earlier discussion on FX. South Africa today might be regarded as an emerging market, although ironically, 50 years ago, it was a developed market. It was a developed market so that it has one of the most robust financial services sector and also financial system. ZAR, the currency, a South African rand, is not the most circulated currency in the world, but it is one of the most traded currency in the world because it is so liquid that global investors use South African rand as a proxy to emerging markets. So basically, whoever wants to trade emerging markets, they will trade South African rand. Whoever wants to trade emerging markets for commodity theme, they will trade South African rand. So that currency is so active and so liquid that global investors actually trade it. I know I'm deviating a little from the question on returns that investors can get from investing into a South African opportunity. So let me give you an example of a private equity case. The reason why I'm trying to use private equity as an example is because, again, as I said, South Africa is a good entry point. For many global investors, that's the springboard to the entire African continent. South Africa is one of the most developed countries in Africa. And thanks to the robust financial system that I mentioned, many global investors would expect a South African business to be successful across Africa. And historically, we have seen that being the case. Like MTN, which is one of the largest mobile carriers in South Africa, is also one of the most powerful in the entire Africa. And similarly, you have banks, South African banks, South African asset managers that are basically dominant across many, many African countries. So when you want to invest into a Africa business, it's also sometimes easy to start with South Africa. Find a good candidate in South Africa and roll out the same business model into other African countries. That has more or less become a winning recipe for many private equity investors who have take interest in Africa. That doesn't solve your question on a subpar return though, and I'll get onto that very soon. But the example I'm trying to give you goes beyond Africa. So we, a few years ago, invested in a soft beverage company. Nothing fancy, conventional soda. Of course, they will have some twist around the soda products. But that being said, I'm sure you have experienced firsthand in the States, for example, carbonized water or some of these fancy drinks have become more popular in the past 10, 20 years, right? And we are seeing similar trends in many other markets too. So we invested into this soft beverage company with a very, very strong team of executives from world's leading beverage companies. People from Coca-Cola, people from other big companies. And they started this business as a brand new South African product. The first step, as I described, is to roll it out to other African markets. But frankly, their product is probably a little too premium for other African markets. So their end game is US. And currently, so a few years later, most of the large US retailers are carrying that product already. The largest single state, I think, is California. So California is where you see many of their products. But this is related to the subpar return question in the sense that what I want to say is there are opportunities in Africa, in South Africa, that can turn into global opportunities. And if it does turn into a global opportunity, I can almost guarantee you are not looking at just African risk or African returns. You are looking at global risk, but also global level of returns. And for that kind of company, we can easily see it become a 10-bagger or a lot more multiples for equity invested just within a period of, let's say, 3 to 5 years. So that is one example. But even if we zoom in to focus on just Africa, I want to challenge the notion of subpar return by saying that we have seen across the board, across different sectors, that pure African opportunities can still outperform and they can still deliver very stellar returns. I might not be able to give you a holistic view in terms of the overall how the overall market performed, etc. But first-hand experience tells us that in many sectors, in many asset classes, be it private credit, be it private equity or infrastructure, you can find very good returns. So now let me end with this. I mentioned infrastructure. Let's assume you build a solar farm. You have pretty much a standardized return profile across solar farms in the US, in Middle East, in Australia, in other markets. But I can tell you this, that the same type of solar farm can yield higher in Africa than many of the other markets. The same logics apply to data centers. So if you have a large data center in Africa, it's not going to be surprising to me that it actually generates a return that is superior to what you can generate on a similar project elsewhere.
Yeah, that's some good analysis, and that's why I wanted to have you on because you're able to talk about actual deployment of capital in a specific asset. We see what's so unique as I kind of relate this a little bit to Israel. Israel, I wouldn't call it an emerging market, I would call it kind of developed, but the reality is very similar where they obviously have an amazing startup ecosystem. There's a lot of talent and a lot of experience and expertise. But what's interesting is a lot of their founder startups, they obviously, go to market in that region there and then they branch over to the US market. And that's where they really hit scale on hyperscale. And I see that very similar to a lot of different other opportunities. So what you're basically saying is that, okay, when you were deploying capital in specifically Africa, one, obviously the currency is very liquid, which is always a beneficial thing, is always good. But then also you looked at that opportunity and said, okay, it's bridging, it's getting exposure to the US market. So there's some sort of also like hedging or like mitigating your risk because when they're in the U.S. market,
Absolutely.
obviously there's a higher probability of being able to produce and develop. And if they're already in retail, et cetera, obviously there's a little bit more conviction behind it. So I definitely appreciate where you're coming from on that. I'm curious though, holistically, we're seeing a lot of larger institutions, raise larger funds for like the Asian market. When we're talking about the Blackstones, we're even talking about large venture capital firms. They're getting large exposure specifically for that to deploy capital, and this might be just U.S. money. And it's very interesting. Are you seeing the same? Do you think over the next few years we'll see a lot more money being deployed in Africa and Australia and so forth? We're seeing a lot of money over in like Israel and Asia and so forth. But I want to get your perspective on those specific markets, Africa and Australia, and then maybe even Asia in Asia, and specifically in regards to obviously with the new administration, do you feel like those relationships will smooth over so that all of a sudden these two economies that were divergent now are convergent and they're coming together and being able to say, hey, look, let's work together in a holistic approach? It's interesting because I think on the geopolitical perspective, as an investor, you don't want to deploy money into a country, of course, that there is, government officials are not like, buddy buddies. And so I wanted to get your perspective holistically on kind of both of the on all three of those subjects there.
Sure. Let me start with Africa and Australia and whether we see more money going into those markets, more US capital, particularly going into those markets. I think the answer is certainly that's a given. However, I want to elaborate on this though. And by the way, this is not just applying to Africa and Australia. It's the same to Europe as well. You mentioned Blackstone. They launched a few new Europe funds, Europe private credit fund, Europe private equity fund. So on an absolute amount basis, I think you definitely will see increase in US money going to all of these markets. But then I guess I will also be looking at the growth. So what I'm saying is the reason why US capital is everywhere is because number one, the abundance of US capital. Number two, the very good returns that it has generated over all these years. Now the snowball is rolling bigger and which allows them to invest more too. So the growth I was alluding to really is domestically, we will see more US capital being deployed too, right? So is the growth of new capital into US opportunity to be larger or smaller than the growth that we see of US capital in Europe, in Australia, and Africa. I am uncertain. I can't make up my mind or have a very confident forecast which market is going to see more of the growth, because it's not necessarily a function of willingness. So being an investor myself, I always want to diversify. I always want to get more exposure to different things, for sure. But one of the key constraints is capacity. Again, I circle back to my point on the abundance of US capital. There's also an abundance of US opportunities. So it's easy for US capital to find their way in these US opportunities. Whereas there are definitely a tremendous number of opportunities across all these markets, Africa, Australia. Will you be able to deploy capital to that large scale as per expectation? Or would you actually run into more roadblocks simply because, you know what, I have too much money, but they can't take all of my money? I think, unfortunately, that has been the case for many markets, including Australia. I know we haven't touched much on Australia, Australia being an advanced economy, one of the most optimistic among OECD countries. It has never experienced a downturn in the past 30 years. Back in the global financial crisis, it was like the only developed economy that didn't experience any decline in GDP growth. With that said, we see so many cases of Australian companies following exactly the path of that South African company, those Israeli companies that you mentioned. They found their way to the US. And that's the ultimate game. That's where you make it big. So one of the ideas that has become so popular nowadays, so well known nowadays, is the idea of buy now, pay later. And I wouldn't say Afterpay was the original inventor of the idea, but Afterpay, an Australian company, is one of the earliest pioneers in that sector. They've been doing it for many, many years in Australia, very successfully. But it wasn't big enough. They went public in New York. They started to do more business in the US, and over a very short period of time, the US business is too many times of their Australian home business. And therefore, I go back to my point on capacity. So if you want US investor wants to really invest into a pure African opportunity or a pure Australian opportunity, ultimately, the capacity is what prevents you from making the multiples that you would love to make. But at the same time, as I mentioned, a lot of these countries, a lot of these companies in these countries will be able to grow into a global business. And in those cases, there will be no ceiling to their growth. And I think that offers good opportunities, right? Now, let me spend a little bit more time on Australia. I think we still see a lot of interesting ideas or opportunities in Australia, not necessarily simply because it is an advanced economy, but also because going back to the buy now, pay later idea, we have seen on many occasions the Australians could be the very early movers of some concepts. And Australia itself is a good enough market to test out those ideas. And as long as a particular idea is well tested, successful in Australia, very often it could be rolled out to other markets. So in that regard, I think Australia is a worth watching market. In some aspects, it's probably more sophisticated than Israel, or at least it is bigger, right? It has a larger population. It is bigger in terms of geographic size, and therefore, as I said, it's a good testing bed. And then as long as an idea is working there, it's possible it could be used elsewhere. So that's Australia. Now let's move on to the geopolitical tension and whether some of the leaders will become buddy buddies. I think the two largest powers are likely to be less hostile to each other over the next five. I think the level of hostility. So first of all, let's rule out the extreme results like a hot war or military conflicts. No, that's not part of the discussion. Simply because number one, I don't want to see it happen. Number two, I don't think there is actually a possibility, a real possibility. So let's forget about that for now. I think more likely the two largest powers will be less hostile simply because I think the level of hostility has reached almost its peak right now, right as we speak. It can't get worse, because if it does get worse, it is war, and that just doesn't make sense, right? So that's that. However, the but is, in the first part of my career, I witnessed a big wave of globalization, which I personally appreciate and enjoyed very much. But in the most recent past, we have now entered into a phase of deglobalization. And to me, that is also a macro secular trend that is not so easily reversed. Or I should say, I do not expect it to be reversed in the next 10, 20 years. So then that led me into this weird or even self-conflicting conclusion that on one hand, I don't think things can get worse. I don't think they will become more hostile to each other. But on the other hand, I don't think they will be working so closely. They wouldn't be working towards another wave of globalization. The whole deglobalization thing will continue for many years to come. From a pure productivity perspective, does it make economic sense? No, it doesn't. If we look at human beings as whole, it will be a lot more effective if we do not need to reinvent the wheels again and again. But inevitably, we are now in this reality that many countries are reinventing their own wheels. One can argue it boosts local knowledge, domestic consumption, local employment. Yeah, all those are true. But again, as a world, this is not helping human beings advance at a faster pace. Ideally, we should all work towards the same AI model, which will really take us to the next level so much faster, right? Let's forget about the constraints around GPUs or a banning prohibition of export of GPUs. All countries just contribute all the GPUs together, and I'm sure we will be so much better off, really, just for mankind. But that, as I said, this is not going to be the case. So I think we will end up in this very peculiar situation where you don't want to actually fight against each other, but you don't want to be friends with each other either. You just want to live on your own. There will be so many different paths, and I'm sure in 10 years, 20 years, when we look back, we probably will regret. We probably will say, you know what, we would have been better off if we had chosen something different. But there's no way of turning back. I think what's bad today is really not just about willingness. It's about the knowledge of each other. I mean, it's such a pity to see that currently in China, there are only less than 10,000 American students studying. Whereas 10 years ago, that number could easily be 500,000. So there are just so few Americans studying in China. And it works the other way around too. I mean, US is issuing far less visas to Chinese students coming to the US in the past few years. If you are doing a STEM major, highly likely you're not going to get a US visa And I mean, I totally get the national security or competition arguments, but the lack of knowledge of each other, the lack of interaction between the two peoples is not going to benefit anyone. But the reason why I'm saying there's no turning back is because that has been the case for too long, and it's just a pity. Whereas, contrasting example that I can share with our audience is that China is now waiving visa requirements on many countries' citizens. And some of the neighbors, like Korea, Japan, for example, particularly South Korea, after China waived the visa requirements, cities like Shanghai, Beijing are seeing a tremendous growth of Korean visitors, tourists over weekends, simply because of the geographic proximity. Like it will only take you 1.5 hour, 2 hours flight to spend a weekend getaway in a Chinese city. So the number of tourists coming from these countries to China is growing exponentially every weekend by weekend. And that's the type of interaction that I actually would love to see between Chinese people and American people as well.
Yeah,
Unfortunately, we're not there yet.
not there yet, not there yet. But what is so interesting is, like you mentioned, the tensions and how that has escalated to such a point now where are we at the point of, okay, there has to be some tensions of decreasing. What's interesting as well is obviously we're very familiar with BRICS, Brazil, Russia, India, China, all coming together, and I believe Mexico as well, coming together and creating their own kind of like G7 structure, right? And what's interesting is if you combine all the BRICS, economically, they have a larger economy and more like GDP potential and growth than obviously the G7. And that again shows to me there's competition. And that's one of the reasons why, as US, I'm hoping with the new administration, we're able to be humble enough to not compete against it, but to embrace it and say, okay, hey, how can we bridge a gap of some sort and building some synergies? Because we understand that we don't want to go to compete against these large economies, right, and miss out on these amazing opportunities. I do know, and I've had some friends where they've been frustrated with trying to go to market in China or go to market in India or whatever, and they're having a hard time even allowing the government to work with us or whatever. And it's so regulated, so stringent, and I understand to some extent, right? Because China, they understand their weight, they understand their how big of economy they have, and so they tend to obviously build their own, their own stuff, their own products, their own whatever, and service it to their own. And then obviously, I do understand that there's a control to some extent. The government has some control over what is being managed, and I think that's also one of the key elements behind it. But it's going to be interesting to see. I do know that obviously the U.S. has also limited, like you just mentioned, regards to visas as well as investors and how much money can be flowing into this country. In specific like China and Russia and India. There's a lot of these. We want to make sure that we limit that investments from international investors. So there's a lot of stipulations, a lot of regulations around it. In fact, it was interesting. I was talking to another friend. They're raising a very large fund and they're investing into a one asset. It's going to be about $1 billion, several $1 billion transaction. And there was a large family office that they're having a conversation with. And the family office was like, hey, we can put up a lot of money, but because of international regulation, they can only have 20% exposure to that specific asset, right? Because there's a regulation saying here in the U.S. that not one entity can own, international entity can own 100%. It's got to be less than 20%, et cetera, et cetera. So all these things which I find so unique, and I understand for a reason, but also I'd love to see how we can bridge that gap because I'm a big believer, and I know this just from experience, when I'm working with other family offices and we collaborate and we bridge that gap in synergies and bringing our own money together and our own resources and our own Rolodex of people, all of a sudden that deal gets done and we're just playing at a different game, right? We're playing at a higher level. And it's going to be interesting to see, okay, if first of all, this new administration coming in with Trump, as well as with specific Asian markets, how we're able to bridge that gap, and if we're able to, and what that looks like to be able to open up economies together and not competitively, but like the synergistic aspect. So it'll be interesting to see. I appreciate your perspective because you're constantly in these markets in Asia, you're constantly in Africa, you're constantly in Australia, and you got boots on the ground, and so you know those markets much more. But I do know in order to change things on the ground, you have to change things from the geopolitical perspective, because I do know that that's kind of the one of the biggest things that are preventing it, and expansion, and go to market strategies and even dollars in those economies, mainly because that geopolitical tension. And so if we're able to kind of eliminate, that's going to be very interesting to see. Theodore, I really appreciate you being on here, man, and just sharing your perspective on this, and obviously giving us really case studies and perfect examples how you're navigating these industries, these geographies, these economies. Because at the end of the day, there is amazing opportunity outside the U.S., and it's really cool to see how we're thinking about that, how you guys are taking advantage of it, definitely at Skybound Capital. So I really appreciate you being on here and discussing this. Are there any last thoughts or anything that you'd like to share before I let you go, man?
Thank you very much, Christian, for offering me the opportunity, and I definitely want to do more of this with you in the future. I guess to close up, my piece of advice to particularly US-based investors is there are many, many different opportunities outside of US. Similar to the opportunities in the US, some will be so successful and offer juicy returns, and some of the others will never make it. But you have to embrace those opportunities because from a portfolio construction perspective, diversification is one of the very few free lunches that you can actually get. But the last piece of advice is if you do go into a market where you don't have boots on the ground, where you don't have enough local knowledge, I strongly encourage you to engage in conversations with managers locally. I'm not necessarily suggesting that you have to invest with all of them, but I guess a conversation, a dialogue with people in those markets could be a very good starting point.
I love it. I love it. Guys, that is the Chief Investment Officer of Skybound Capital, the one and only Theodore Shou. Is that a Journey with Christian Evans podcast? Until next time, be uncommon if you can.